Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of corporate finance with a little bit of sass and a lot of clarity. Today we're dissecting Viant Technology's latest quarterly report, and let's just say it's a performance review that's got us raising an eyebrow or two, especially when we look at how much cash they're actually seeing versus what they're bringing in. Before we dive in though, if you love getting these kinds of super clear breakdowns of what these massive filings actually mean for companies you might be invested in or just curious about, make sure you hit subscribe. And hey, we've got a fantastic community over on our Discord server linked in the description below where we break down even more. So Viant Technology Inc., folks, this is a company that operates in the advertising technology space. Think of them as the digital matchmakers for advertisers and the places where ads show up online, like websites and apps. They've got this platform that helps plan, buy, and measure advertising across different screens and channels. It sounds pretty straightforward, but when you peel back the layers of their financial statements, you find a much more interesting story. Let's start with the top line, the revenue. For the 3 months ending June 30th of 2025, they reported a revenue of about $77.9 million. In the same period last year, that's a respectable 18% jump. And they're saying this growth is mainly driven by increases in revenue from certain industry verticals like business services, consumer goods, retail, and healthcare. So it seems like they're doing well with specific types of advertisers, but here's where things get a bit more complicated. When you look at their operating expenses, their platform operations costs jumped by about 19% to $41.9 million. Now, a chunk of this goes to traffic acquisition costs, or TAC, which are basically the cost to get ads in front of people. This cost went up significantly by 21%. This means that for every dollar they made, a bigger chunk of it is being spent just to get the ad placement in the first place. This is a really important number because it directly eats into their profits. And when you look at this relationship for the 6 months ending June 30th of 2025, their platform operations expenses increased by a whopping 26% to $82 million, while their revenue grew by 25%. The cost of actually delivering that revenue grew just a little bit faster. This is a classic sign that their margins might be getting squeezed. They're growing, but it's costing them more to do so. Now they do try to smooth out some of these numbers by removing things like stock-based compensation and other one-time charges to get to what they call non-GAAP operating expenses. For the 6 months, this number came in at $74.44 million, up 18%. While this is a smaller increase than the 26% jump in total platform operations, it still shows that their core operations, it still shows that their core operational costs are climbing significantly. Ultimately, managing these costs is key to their profitability. Here's a really telling metric: adjusted EBITDA as a percentage of contribution ex-TAC. For the 6 months of 2020-25, this figure stood at 18%. Now that might sound decent on its own, but compare that to the 17% they had in the same period of 2024. While it did increase slightly, the fact that their costs are rising faster than their revenue growth in some segments means they need to be really careful about how they manage their spending. It's like running a race where the finish line keeps moving further away. And speaking of profit, let's talk about the bottom line. For the 6 months ending June 30th of 2025, Viant Technology Inc. reported a net loss of $900,000 attributable to their shareholders. This is a slight improvement compared to the loss of $892,000 in the same period of 2024. While an improvement is good, they are still essentially losing money on a reported basis. This is a concern for any company, especially one that's trying to grow. When we look at their non-GAAP figures, the picture is a little rosier with a non-GAAP net income of $10.8 million for the 6 months. However, when you look at this as a percentage of their gross profit, it's only about 2% for the 6 months of 2025, down from 3% a year prior. This shows that even when you adjust for some of the one-time or non-cash expenses, their ability to convert sales into actual profit is shrinking, and this struggle to turn a profit is reflected in their balance sheet. Their accumulated deficit has ballooned to a negative $75.7 million as of June 30th. This means that over their lifetime as a company, they've spent more than they've earned. While that's not unusual for many growing tech companies, it emphasizes the pressure they're under to eventually become profitable. Now, let's talk about the risks they're highlighting. and boy, are there a lot of them. They're really emphasizing the reliance on enhancing and improving their platform and training customers. This tells me they might be struggling to get customers to fully utilize what they're offering, or perhaps their platform is more complex than it appears. They also point out the uncertainty around the industry shifting away from cookie-based tracking, which is a big deal in digital advertising. If this shift doesn't happen as they expect, or if their competitors adapt better, they could be in trouble. A really crucial risk factor for them is their dependence on a select group of advertising agencies. They mention that a significant amount of their revenue comes from these agencies, and losing even a few of these large clients could really hurt their business. This is a classic concentration risk you always want to watch out for. It means a big chunk of their success rests on the shoulders of a few relationships. They're also betting big on artificial intelligence, especially with their Viant AI product suite. But they're very upfront about the risks. They say that AI might not deliver the expected benefits, could lead to performance declines, or even cause them to incur liability if things go wrong with privacy, laws, or contracts. This is a double-edged sword. AI can be a huge advantage, but if it's not implemented perfectly, it can also be a major liability if things go wrong with privacy, laws, or contracts. This is a double-edged sword. AI can be a huge advantage, but if it's not implemented perfectly, it can also be a major liability. And of course, no tech company report would be complete without mentioning cybersecurity. They're constantly targets for attacks, and a breach of their systems or data could be a disaster for their business and reputation. They admit they have experienced cyber attacks and expect them to continue. This is a persistent challenge in the tech world. Looking at their financial position, it's clear they rely heavily on their subsidiary, Viant Technology LLC. They're a holding company with limited operations of their own, meaning their ability to pay bills, taxes, and anything else hinges on money flowing down from that subsidiary. This structure introduces another layer of complexity and potential risk about how cash moves within the company. As for their capital needs, they're not shy about saying they might need more money. They anticipate needing additional funds for developing new features, improving infrastructure, and potentially acquisitions. If they can't get this funding on good terms, their growth could really hit a wall. This means investors need to be aware that future stock sales could dilute their ownership. Now let's get to my take on all of this. Viant Technology is showing revenue growth, which is a positive sign. They're expanding their reach into important sectors like retail and healthcare, and their investments in AI show they're trying to stay ahead of the curve. However, the core issue I see is that their costs, particularly the traffic acquisition costs and overall platform operations, are increasing at a pace that's often matching or even slightly exceeding their revenue growth. This constant upward pressure on expenses is eating into their profitability. While their adjusted EBITDA shows positive trends, the shrinking percentage of gross profit that turns into net income is a red flag. They seem to be in a constant battle to balance growth with profitability. While their adjusted EBITDA shows positive trends, the shrinking percentage of gross profit that turns into net income is a red flag. They seem to be in a constant battle to balance growth with profitability. The heavy reliance on a few large advertising agencies is also a significant risk. If even one of those relationships falters, it could have a substantial impact. The company's future truly hinges on In conclusion, Viant is in a growth phase, which is exciting, but it's a very expensive growth phase. They need to prove they can eventually turn this top-line growth into solid, sustainable profits. Right now, it feels like they're spending a lot to get that revenue, and the translation into actual profit is still very much a work in progress. What do you guys think of these growth numbers? Strong enough to overlook the cost pressures, or is the company's future looking a bit too risky? Let me know your thoughts in the comments below. If you found this breakdown helpful, give this video a thumbs up. Really helps us out, and consider subscribing for more unfiltered looks into company performance. Also, don't forget to join our Discord community. It's a great place to connect and discuss these kinds of insights. Thanks for watching, and we'll see you in the next one.